Start. Good evening, team. Hope you guys are doing good. Thanks for joining in. So today we are here to talk about the MF Way Forward, the equity and debt report which we have prepared for the month December 2018. I'm sure most of you must be looking out for the same, as markets are volatile and we need something to be spoken to our clients during all our meets and the way ahead. So here we are to start off with the report directly, since it's a while and we have been already delayed. So sorry for that. Moving down now. How do you scroll this? Sorry for the inconvenience, guys. So taking you through the report today. So we would broadly cover the contents, the industry trends, the equity market outlook, the fund house views on the equity markets, the debt market outlook. What is the view on the debt houses on the markets? The tactical asset allocation, the ideal strategy, what we feel ahead, the model portfolios based on the technical views. So we have preferred three risk appetites: aggressive portfolio, moderate, and conservative for the clients, and the recommended mutual funds which we have the screens as per the being abundant as per the tactical view which we offer. So to start off with, what are the industry trends? We all can see that the inflows in the equity markets, equity mutual funds especially, have dropped by 33%, which is to rupees 8,414 crores in November 2018. And that's a sharp decline in the month of November compared to the gross sales, which has fallen to about 7,200 crores from 15,614 crores, which was there previously. That's all due because of weak market sentiments, and SEBI's ban on upfront commission are some of the key causes for the decline in the investor appetite. Or probably we would see the uprise or the gains in the momentum back again once people are used to the trail commissions, and it's all about volumes now rather than the upfront commissioning, which is one of the reasons which is said to be the decline in the AUMs for. However, the SIPs have been growing, but currently it's just been stagnant, almost close short towards the rupees 8,000 crores mark. The net inflow in equity mutual funds after a decline of 8 whole months has a higher net flow inflow of rupees 12,622 crores in October 2018. The SIP inflows, which were growing strongly over the past 1 year, have now been stagnated at 8,000 crores as mentioned. The net inflows in balance funds has been dismal. In fact, they have gone down by 50%, about 215 crores odd compared to 519 crores in October 2018. Income funds net inflows have further reduced as the outflows have increased. The net outflow for November 2018 has been reduced to 6,518 crores compared to 37,642 crores in October. But still, that's an outflow. There's no inflow in income funds. However, we see that probably the flows have moved towards liquid funds as the liquid and money market funds reported a net inflow of 1.36 lakh crores in November 2018, which has compared to an inflow of 0.55 lakh crores or 55,000 crores in October 2018. So that's almost a 3 times jump from where we were in 2018 October last month. So we observed in October 2018 a record purchase in the mutual fund investments in equity of 24,000 crores, which has fell to about 4,896 crores in November. So that's a drastic fall of almost one-sixth value of the value we had last month. So slower inflows from investors in mutual funds is a key factor. Somewhere the reason for that is also that FIIs have increased the interest rates back in US, US increasing the interest rates. FIIs have continued to be investing there, then coming down to India over the last month. Again, a key indicator, FII investments in equity. There's been a massive outflow of 27,000 crores from October. FIIs were net buyers, however, in November, which is about 5,981 crores over the past 12 months, which has been one of the figures. FIIs over the last 12 months have sold 40,355 crores of Indian equity, which is substantial. So on the debt side, the mutual fund investments seem to be promising. There's been a net inflow, which is almost a double value of the last month. There's a net inflow of 52,354 crores in November 2008 against an inflow of 27,364 crores in October 2018. Again, one more positive sign, FII investments in debt have been positive as the net buyers of Indian debt in 2018. After two consecutive months, sorry for that, after 2 consecutive months of outflows in September and October, which reported a net outflow of close to 10,000 odd crores, November has been a positive month with a net buying of 5,600 crores in net. So if you look at the alpha, it's been about 15,000 inflows which has taken place in the last 1 month, which is quite substantial compared to the track record what we have seen for the last 12 months, where there has been a total outflows over the past 12 months has been total to about 50,230 crores, quite sizable number. Primarily due to the interest rates upside in the US markets, the trend has been seen for an outflow from the Indian market. So yes, now coming to the performance of how the Nifty 50 index has performed as contributors. So one again a positive number. Nifty 50 index has closed with a gain compared to the previous months. The earnings of the index has gained more than 5%, which is about 5.42% over the 1 month period compared to a 6% decline in October 2018. So if you look at again the alpha from October to November, it's been about 11%, which is quite substantial. The top five stocks weightage contributed to as much as 78% to the total index gains, which again tells it all that majorly it's the top five stocks which rally the index. So out of the total 50 Nifty 50 stocks, 31 stocks have been gainers with an average return of 8.41%, whereas the losers have had a total of 19 stocks with an average return of minus 7.23%. Top gainers mainly consist of BPCL, Maruti Suzuki, and Adani Ports and SEZ. That's the free zone. Then we have IndusInd Bank, Ultratech Cement. All of their 1 month returns are hovering around minimum of 14.3% returns to maximum of 17.92 given by BPCL. The top five losers again stands from a pharma, namely starting with Sun Pharma 15.11% negative returns over the last 1 month. India Bulls Housing Finance, clear indication on the NBFC's piece, which is minus 14.26%. Again, there's a pharma stock, which is Cipla, minus 14.05%, NTPC minus 12.12, Yes Bank, which is minus 9.73. Top five index contributors, really the big names: Reliance Industries, HDFC Bank, HDFC, Maruti Suzuki India, Hindustan Lever. So all large caps, average approximate weightage on index is from 8.85% of Reliance Industries to 4.2.63 of Maruti Suzuki. So the total, if we take as of October 31st, 2018, is 26.94, roughly 27% with the top five index contributors. The average monthly incomes is highest contributed by Maruti Suzuki of 15.8% to a minimum of 8.16 from Hindustan Lever, which is quite substantial. Contribution to index again ranges from 23.58% by Reliance Industries to 10.02% of Hindustan Lever. The total contribution to index is 78.47% as mentioned earlier. So now we have to also see that parameter, that what is the extent of fall right from January 2018 to November 2018 in the stocks, predominantly from their higher price to the current price. So what we have largely seen is small caps and mid caps have corrected the most from their peaks. About 40% of the BSE stocks, 500 stocks, have corrected between 20 to 40% in the last 11 odd months. Nearly 80% of the small cap stocks have corrected by over 30% from their peaks, which says it all. That is the time to enter the small cap and the mid cap category. The extent of fall for stocks and mutual funds. Mutual funds have been troubled by the small caps in their portfolios, as many as 61% of the stocks have been corrected by over 30% from their peaks. So whether it's large cap, mid cap, or small caps, percentage of fall has been substantial this year, and which has affected the mutual fund performance as well as the equity of the last 7 odd months. The market moved out of a correction mode in November 2018. The Nifty 50 has gained over 5% in the month, but the broader Nifty 500 index moved higher by about 6%. The Nifty mid cap has gained, 100 has gained 3.8%, while the small cap Nifty has moved up by about 4%. So in total, all the Nifty indexes have given a positive performance after a negative trend over the last few months, is what has been seen. The views or the equity market outlook, what is there, are basic basis the pointers which are likely to be discussed. The government is likely to have a miss on the FIL target, which is as per the great rating agencies we know, namely Moody and Indian Ratings. Their concern is that the Indian markets might not meet their fiscal deficit target due to a shortfall in their revenues. However, the government is stating that they are confident of meeting their fiscal deficit target of 3.3% of GDP. The reason for the Moody's Indian ratings stating that the government would not be able to do so is falling behind of the indirect taxes and the non-tax revenues, and thus they will not be able to meet their disinvestment target. However, this sign is not a good sign on the fiscal deficit front, which would lead a turmoil for the equity markets, at least for the short term. The earnings per share have downgraded, which is a key risk on the GDP growth rate of the markets. So, out of the S&P BSE 200 constituents, as many as 68% faced a earnings downgrade, which is a huge percentage, while just 29% enjoyed an upgrade in earning per share for FY19. So, quarter two earnings led to more disappointments than positive surprises. Going ahead, the growth drivers are likely to change, which could create a disruption in earnings. A change in the direction of crude oil and depreciation of rupee has changed the narratives of earning growth going ahead. So yes, of course, the currency being controlled and crude oil going at a lower value, we could see some positive sparks on the upside, but that's uh, just for the time being, while both of them are curved within a certain range, which is quite highly unlikely in the long run. The geopolitical events tends to find a ease as US and China have called for a truce, a discussion in the early December at the G20 summit. Yet markets could continue to remain nervous on possibilities of further escalations of trade war, along with which US Federal Reserve decides to change its stance on rate hikes. Okay, if in case the rate hikes do not happen, then it's a positive effect which the Indian equities could see. For now, the US Fed has indicated a slowdown in the interest rate hikes. So that's still a positive chance that in the next 3-4 months, by the time the FY 1920 is over, we could see some positive sparks in the equity markets. One of the major factors which would drive the equity markets, at least for the next 6 months, would be the upcoming general elections. So while we have seen that the state elections are done with, we are all now having eyes on the general elections, and the steps to current government is likely to take in order to win back the voters. The outcome of the state assembly election did not spook the markets early in December, but however, the Modi-led BJP government remains in favorite for the general elections, which could give it a positive trend to the equity markets as well. Fund house views on the equity markets are basically on the short term to medium term risk easing. The crude oil prices and rupee continue to remain in favorable zone, and the benchmark interest rates, which were projected to be hiked in the coming months, is likely to remain unchanged this fiscal year. So this gives the market a much needed boost, which was there to be realized in the past month or so. Though crude oil prices and rupee are expected to remain subdued, any global upset but still could create volatility in the markets. So as we all know, mid cap and small cap stocks are beginning to look attractive as over the last few months, or rather 6 to 8 months, they have corrected big time by almost 40 to 60%. Though the Nifty 50 has generated a positive return of 6% over 1 year, the mid cap Nifty and the small cap Nifty have gone down by 12% and 28% each. So, on looking the past data and the divergent performance has showed last lead to a sharp recovery in mid caps and small cap stocks in the following months. At the current levels, the mid caps and small caps seem to be quite attractive and expected to have a recovery, and is a great time to get into them and buy them out. Election years generally are volatile often, and with the state elections being done and now general elections where Modi government needs to prove themselves, yes, there's going to be a close fight, which leads to the volatility game, and a hung parliament may send the market in a teasy situation, while the majority government with either party should be a positive for the market. Sensex valuations are above the fair value. Forward price to earning ratios of the S&P BSE Sensex is just short of Japan's Nikkei 225 but higher than the benchmark indices of Hong Kong, China, Brazil, and developed market indexes. Valuations have cooled off in the month earlier, but are on the rise once again. In such markets, when the several risks at play, it is best to approach the market with caution and shift to large caps bias than to a multi-cap bias. So one should shift from large cap bias to multi-cap bias so that one can take the advantage of the markets depending on the market scenarios in the near term. Threat to near-term growth. So yes, of course, with the elections in place, private vehicle sales have slowed down. This has added to the already weak rural wage growth. Auto volumes have moderated with the near-term demand trajectory, also appearing slightly uncertain due to rising cost of ownership. However, the steel consumption growth has held up well. Domestic demand indicators remain under pressure because of unfavorable base effect from GST and delayed festive season this year. So the demand indicators are mixed, but however, investment indicators and nascent recovery in private capex continue to bode well for the broader recovery in the economy. Peaked out NBA cycle. The worst of the NPA crisis has troubled the banks seems to be over. The credit growth is seeping back, as per IBI reports. The share of gross NPAs in total advances of banks, both in public and private sector, peaked in March 2018 and has since declined in both June and September quarter of the current fiscal year. The NPA crisis is more widespread in the public sector banks. The twin balance sheet problems where banks were unable to lend due to their bad loans and companies were unable to borrow under burden existing loans seems to be easing. The 10-year GSEC has eased out further from 7.8% at the beginning of the month to under 7.5% present. This is the lowest yield since April this year. Once again, investing in the longer ends of the yield curve benefit over the past month and have recovered some of their losses from the previous month. Thus, over the past year, the liquid fund index continues to lead with a return of 7.5%, while the short term and composite bond index funds trail with the returns of 5.6 and 3.8% respectively each. The upsides risk to inflation is the RBI Monetary Policy Committee has kept the benchmark repo rate unchanged at 6.5% and retained the stance of calibrating tightening. Inflation cooled off to its lowest since June 2017 and has remained below the RBI's estimates in recent months. The RBI now expects inflation to remain between 2.7% to 3.2 for the second half of the year. This is within the flexible inflation target of 4 plus minus 2% set by MPC. So liquidity has been improving is what the expectations are. RBI conducted OMOs aggregating to 40,000 crores in November 2018. Systematic liquidity during November 2018 remained negative and closed at negative of 44,000 crores versus negative of 87,000 crores at the beginning of the month. The central bank further announced a round of OMOs in December 2018, while the indicating of the OMOs may continue till the end of the financial year. As a result, the bank liquidity has improved and GSEC yields too have declined considerably. So, as there's liquidity created in the markets with the OMO operations, the GSEC rates have tend fallen down, which is a good sign for the debt markets as well as the equity markets also, that there would be a lot of funding available for the equity markets. Concerns regarding NBFC refinancing may be a waiting. Yes, of course, NBFCs are still a concern with the short-term borrowings as a percentage of their total borrowings. Most NBFCs have been correcting their asset management liability books by issuing lesser amount of commercial papers and higher amount of NCDs. Credit spreads have widening, leading to a good investment opportunity once again on the credit risk funds for the investors for the near-term investments for a 2 to 3 span. So as we all were expecting last month that the rates would be hiked, which is not the case. On in the December meeting, the board has decided not to hike the rate as of now because of the rupee stabilizing and the crude oil being under control on the level side. However, we would be seeing there would be a bi-monthly policy being announced on February 7, 2019, which might have an upside on interest rates, but likely it's still expected to not be there, which could be a positive sign for the long-term yield funds or the duration bond funds. However, for now, we would still recommend one to be invested into a short-term fund as the yields are quite lucrative in the range of 8.5 to 9.5%, which is quite substantial at this point of time with the current interest rates prevailing in the markets. IM RBI OMO program, which is the open market operations to support the long-term bonds. So once again, RBI would be tending to decrease the interest rates, which is like increasing liquidity in the markets, which would lead to interest rates going down, whereas which is the sign that the GSEC rates have gone down to now 7.5%, which were 7.8% last month, and thus helping the long-term bonds or the duration bond funds to give one an alpha on the upside with the price rise. So the OMO conducted by RBI had purchase of 36,000 crores in October, which has now gone up to 40,000 crores in November 2018, and the same is amounting to 40,000 crores in December. Thus, once the liquidity in the system increases, one could look at the yields moving upwards. A shift to higher duration, as stated, rate hikes are unlikely in the short to medium term. The yield curve has been flattening out, and the fund houses are increasing the duration in their portfolios. Yet, on the cautious side, one can stick to low duration schemes. Those willing to take an additional risk can go into dynamic duration schemes, which are expected to outperform in the medium term. So, basis the above outlooks of the fund manager, how do you house views, and the market outlooks, we have made some technical allocations for clients in our portfolios across active clients, I mean aggressive clients, moderate and conservative clients. Our ideal strategy on the tactical view would be, as per the equity investments are concerned, preference should always still be given to large cap funds. Multi cap funds with a large cap bias can also be considered. Mid cap and small cap funds can be turned attractive investments, though one should do it through systematic investment plans for a long term. Asset allocation funds or equity oriented hybrid funds are the best suited to ride out the market volatility, even in the current state of affairs. Very aggressive investors can opt for sector funds such as in pharma and consumption phase because as they are looking positive over a 3 to 5 year perspective. On the debt side, one should look to stick to low duration or short duration funds in the market volatility. Debt schemes such as floater funds with an accrual strategy will help capture the current elevated yields. The dynamic bond funds can help position one to take the benefit of advantage of the duration of the portfolio to benefit from the volatility in the debt market over the medium term. Credit risk funds also offer decent spreads in the current market scenarios and have an opportunity for one to earn a higher return as compared to similar funds with the same duration. Now coming to the model portfolios as per our tactical views. So as we state always, aggressive risk portfolios, we give a 90% exposure to equity and 10% to debt. However, on the equity side, out of the 90% equity exposure, 50% goes in large caps, 20% is predominantly mid caps, 20% sectoral funds, and 10% on the dynamic bond funds. So these are clients who are looking at investments for a longer horizon of around 3 to 5 years with a long-term capital growth can go into such kind of investments. The top funds in each category are specified below. To name it, on the large cap side, we have Access Blue Chip Fund, UTI Master Share, ICICI Approved Blue Chip Fund. These have outperformed the markets by far, almost giving a return of 10.61% over a 3 year span, starting to with Access Blue Chip, one of the best rated funds in the last couple of years. On the mid cap side, again, there's Access Mid Cap, HDFC Mid Cap Opportunities Fund. So equal allocations to both of them. Then we have the sector funds. So as we have specified on the consumption space and the pharma space, we have taken one fund from each category. UTI India Lifestyle Fund is one of the great funds on the consumption space, and Reliance Pharma to be one on the pharma sector. Since it's a listed portfolio, we have constituted the 10% of the debt to the duration funds. Namely, the fund which one could look at would be a Franklin India Dynamic Accrual Fund and the ICICI Pru All Seasons Fund. So their performances over 3 year perspective have been quite significant of almost a 9% return, which is substantial. On the moderate risk portfolio, one would is for a client who would look for regular returns on the interest side and a long-term gain on equity as well as income generation from the debt side. So the exposure for this client would be over a period of 2 years averagely, and the exposure on equity and debt would be equivalent, 50% each. Suggested allocation: aggressive hybrid funds 50%, large cap funds 15, short duration funds 20%, dynamic bond funds 10%, and credit risk funds 5%. Out here, we have also put in an asterisk across aggressive hybrid funds just to allocate that it contains 70% of equity and 30% debt. Hence, with the 50% allocation, the portfolio will contribute for 35% of its investments towards equity, and the remaining 15 would be in debt to ensure that one gets a 50-50 allocation on the moderate risk portfolio. Again, the list of top funds of each category are provided below with their performances. Namely, on the aggressive hybrid fund, we have ICICI Pru Equity and Debt Fund, which was earlier known as the ICICI Best Advantage Fund. So one knows that the performance of such fund is quite substantial, and since inception also it's given about 14 to 15% returns. The next fund would be Reliance Equity Hybrid Fund. Large cap short term duration funds, dynamic bond funds are something which we have seen in the previous strategy also. So names are mentioned there. On the conservative side, somebody who's looking for a short term investment of 1 to 2 years, one can look into a short term duration fund with a moderate to low risk portfolio for his investments. The investments in these uh, risk profile are only restricted to 20% on the equity side and about 80% on the debt side to have a conservative risk appetite. 20% of the equity is invested into large cap funds, whereas the remaining 80% is going into debt funds, right from low duration funds taking a 20% allocation to short duration funds having 30%, floater funds 20%, and dynamic bond funds 10%. So out of the entire lot, only the dynamic bond funds are something which has a higher volatility, and the remaining tend to remain as conservative as the strategy of the client or his risk profile. The list of funds are mentioned below as per one's requirement and research and analysis. The model portfolio performance of the three portfolios has been provided below as on inception since September 15, 2018. So despite it's only been 3 months, we have been able to see the performance of the funds. The portfolio performed on the aggressive portfolio has been minus 5% down, 5.4%, whereas the benchmark has performed to about minus 6.08%. So yes, of course, we are seeing a downfall, a negative return, but compared to the benchmark, it's still 1% higher. And 3 months is a short time frame for any to judge any funds. But however, if we look at the positive side, if something is negative right now, it's a good time to get in with a 3 year perspective at least. The moderate risk portfolio, if you see the return, has been beaten by the benchmark by marginally by 0.6% as of now. But again, as I said, 3 months is a lesser time frame to actually get the risk model portfolios. And on the conservative portfolio side, it has seen an upside or probably at par with the benchmark, which is 0.7% compared to the benchmark being 0.57%. But still a decent bet. So we should probably look at the 3 months, 6 months, 1 year performance, which would give us an indicator how the model portfolios helped and be up the curve compared to the benchmarks. So the performance of the recommended mutual funds as per the technical view have been shared separately on these slides. These are just repetitive and a few more schemes which one could look at. for their recommendations to their clients as well. On the sectoral fund size, we have given you funds of consumption and pharma categories as we are promoting, as we would say in the current market scenarios. Those are the ones we would be bullish on. Followed by the debt funds performances and according to their categories. That's it from my side. If you have any comments or suggestions, do put it across to us on our email ID. That's ws@plindia.com, or you could write us to this particular email ID or call us on the numbers given below. We would be more than happy to help. Our team is names are mentioned there, and the report has been prepared by Mr. Jason Montario. He is the mutual fund research and content uh, in charge we have. Thank you for joining us. Looking forward to see you next month with a new report on mutual funds, way forward, equity and debt, January 2018. Then, bye bye. Take care. Have a great weekend. YouTube for us.